Let's go back to our top story today as the Commonwealth Bank shares slumped after what on the surface seemed to be a relatively solid first quarter financial result. But it means now all the major banks in the past couple of weeks have produced financial results. Now, there's a key theme that I can see emerging from these results, and that is that in most cases, expenses are rising faster than income. The cost of wages and technology seem to be crimping banks' profits, along with slow national economic growth. Well, David Heathcote is KPMG Australia's head of banking and capital markets. He's been crunching the numbers on these bank results and joins me now. David, good to chat to you. Is that a broad summation as to what you're also seeing from these bank results?
Yeah, I think that's a pretty good summary, Ross. Overall, we've seen growth at the top line in operating income. It's marginally increased in a pretty difficult environment. We've had 3 interest rate cuts, which is obviously having a little bit of an impact on net interest margins. But interestingly, the net interest margins actually increased by about 3 basis points. So, the banks are managing their returns and income pretty well. On the expense line, as you've mentioned, we've seen, significant increase in technology costs, which is, again, looking at trying to create efficiencies. The number actually increased by 10.5% to $9.9 billion. So that is a significant uplift. But I think the intention here is to create those efficiencies over a longer term, which should help the banks be more efficient and productive in future years.
I was going to say, there's almost a race on between these banks. They always compete. Home loans, business loans. We know that they therefore sometimes slice margins in order to get that business. But the real race between these banks is right now about technology. To get to that digital future, the Commonwealth Bank seems to have a bit of a lead in this, but everybody is pouring enormous amounts of money into the area. But the problem is technology costs are rising faster than income is right now.
Yeah, we've seen it across all the banks, and interestingly, they're all developing and accelerating at speed their digital offerings, which obviously needs a lot of technology to drive that. So I think it's the right step. They're also facing a lot of competition from outside the big 4 banks as well, and that's impacting some of the market share and the dynamics, whether that's in the business bank or whether it's in the mortgage area or personal loans. So it's another factor that the banks are looking at closely, and also highlights the need to invest in digitisation.
So the big area where banks traditionally have made their money is in home mortgages. And we know there's always a lot of competition in that space. But right now, the margins for banks are in business lending. And it seems they're all really chasing those business loans, even though, of course, the potential for loss or businesses going bad is higher in that area than it is for consumers buying homes.
Yeah, certainly we've seen a slight uptick in the defaults and the loan provisioning, and particularly in 2 sectors we've seen an increase, and that's in agriculture and construction. The banks will selectively, target their areas where they want to grow business lending. It's a little bit unique and niche, so it's not as simple as going aggressively on the mortgage market, which is a lot more straightforward, and you've got asset backing. Business lending, you really need to understand the credit quality of the entity that you are lending to. So they will be looking at their own strategies and analysis to determine where they want to run hard, but you're certainly right that the returns on those investments are typically higher than what you'd get in the mortgage market.
Okay, then take me to something which is a bit left field. In America, in the past week, you saw the US Federal Reserve pump $125 billion of liquidity into the US banking system, which partly had something to do with the government shutdowns there, which are now coming to an end. But here in Australia, just describe for me the liquidity and also the underlying security of our banks, because we know nothing causes an economic downturn faster than a lack of liquidity in your banking system.
Yeah, look, the liquidity ratios of the banks, whilst they've decreased marginally, they're still at exceptionally high levels, particularly when you compare it to the rest of the world. So we're pretty confident that, the liquidity levels and the creditworthiness of the banks is very strong. They've all got very high credit ratings. So I'm confident that, that's something that they manage well. I assume and I suspect that in the US, they're really trying to create that stimulation. There's deregulation as well in that market, and therefore, those financial institutions would probably welcome that level of stimulus to try and grow and get the economy going again.
Yeah, so true. But here in Australia, one other aspect of our banks, they've had remarkably low bad and doubtful debts for almost 10 years now. And the reality is that has driven some of the enormous profit increases we've seen in our banks during that time. They've collectively, over the past year, made the best part of $30 billion. Now, what I'm wondering is when you look forward, if interest rates are going to continue to fall, then the security of those banks, the security of those loans is going to remain incredibly strong here in Australia.
Yeah, that's right. In fact, we are seeing home loan prices increase again, which is a real positive. That's why the level of expected credit losses, when you look against the value of the assets, is actually declining at the moment. Which is a real sign that the asset values are improving, again, which is a very positive message for the banks and also for the borrowers of the loans.
I'll tell you, David Heathcote, really good to chat to you today. Great analysis. Many thanks for your time.
Thanks, Ross. Pleasure to be here.